Welcome to my YouTube channel, The Executive Outcome. My name is Michael Mansarioba. I'm here to make a presentation on taxation of mining operations in Zambia, Part 1. Navigating the fiscal landscape. Zambia is rich in various minerals that include copper, cobalt, gold, emeralds, nickel, and uranium. The industry roots trace back to British colonial period when industrial scale mining began. This is way back in 1888. This was actually pioneered by British South African company through Cecil Rhodes, who secured mining rights, and hence colonization of the northern Rhodesia began. Mining sector is a major contributor to Zambian gross domestic product. According to the Brief on Mines and Minerals Bill of 2023, Budget National Assembly of Zambia, we get the fact that 41.8% of government revenue came from mining activities. Minerals such as copper generate substantial export earnings. Also, take note that the mining sector provides for a significant portion of Zambian workforce and has drawn foreign investment from prominent mining companies. According to Zambia Chamber of Mines, publication of issue number 13 of 2023, the mines accounted for 62,236 Zambian employees. So you can see that we have this particular economic activity playing a very significant role in Zambian economy. When you look at mining, a number of facts can be talked about, especially as it relates to Zambian mining operations. Mining projects involve extracting minerals from the ground and separating different minerals from each other. The extraction is typically carried out in an open pit or an underground mine, while separating minerals take place in a processing plant. As a result of mining operations, mining wastes are produced and need to be managed. As the mining operations cease, the mines go through a period of mine closure. During this period, the mine is decommissioned and remediated. Mining is governed by Mines and Mineral Development Act number 11 of 2015, which defines it as the extraction of solid, liquid, or gaseous material from beneath the surface of the earth in order to win minerals or any operations directly or indirectly necessary or incidental thereto. A mineral is any substance, therefore, occurring naturally or on the earth or in or underwater, formed by or subjected to a geological process, excluding, for instance, water, other than water taken from the land or any water body for the extraction of any mineral from such water. B. Petroleum is also included. To carry out mining operations, a mining right is required. Mining rights may be granted in form of 1. Exploration license, 2. Mining license. We also have non-mining rights. The following are some of the non-mining rights. 1. A mineral processing license. 2. A mineral trading permit. 3. A mineral import permit. 4. A mineral export permit. So these are some of the things that we need to look at. Then what is important also is to take note of the types of taxes that are going to be confronted in Zambia relating to mining. These taxes include corporate income tax, mineral royalty, value-added tax, and customs and excise duties. Relating to corporate income tax, you should understand that there is a standard rate for corporate income tax of 30% that applies. Firms registered with income tax and have turnover of 800,000 and above are subjected to the following tax rates relating to mining. Mining operations at 30%, mineral processing also at 30%. Where it comes to manufacturing of products from copper, such entities are taxed at 15%. With this regard, it should be noted that when we have multiple rates, they end up affecting the Zambian tax in that these multiple rates narrow the tax basis. And as a result, we have avoidance opportunities created, and large informal sector have led to low capital income tax revenue productivity. Special rules also apply for mining. Specific provision may apply, in this case, such as carry forward and capital allowances. For mines, the loss can be rolled forward to a maximum of 10 years. After the 10-year period from the instance of the loss, that loss, if it's still outstanding, is lost. It cannot be used as a relief anymore. So we can have a number of corporate income tax rates, but particularly interested in mining, we have, as I've said, mineral processing at 30, mining at 30, manufacturing of products using copper cathode at 15%. So that is what is relating to mining, relating to corporate income tax. We come to the other part, which is mineral royalties. A mineral royalty is a payment made by a person in possession of mineral rights, such as a mineral processing license for the extraction of minerals. It is charged on the quantity of mineral extracted and then sold per month rather than profit, and so is payable as soon as production begins, providing an income stream for the government even though an operation may never be profitable. Now, you should also take note that there are certain provisions, special provisions, where different minerals may have varying royalty rates. The Act actually classifies minerals into a number of classes for the purpose of computing the mineral royalties. So we are going to look at a number of these classifications of minerals. One can be a classification relating to base metals. What is a base metal? This is a non-precious metal that is common or chemically active, or both common and chemical active, that is. These include iron, copper, nickel, aluminium, zinc, tin, magnesium, cobalt, manganese, titanium, scandium, vanadium, molybdenum, and rare earth elements. That falls under base metal. The second classification relates to industrial minerals. What are these industrial minerals? This is a rock or mineral other than gemstone, base metal, energy minerals, or precious metals used either in their natural state or other physical or chemical transformation. This includes barite, dolomite, feldspar, fluorspar, graphite, gypsum, ironstone when used in fixing argent, kyanite, limestone, phyllite, magnesite, mica, nitrate, phosphate, pyrophyllite, salt, sand, clay, talc, laterite, gravel, potash, potassium minerals, granite, marble, silica, diatomite, kaolin, bentonite, and quartz, including any other mineral that the minister by statute order may so classify. So this is the second class, or the second classification. The third classification relates to energy minerals. These include coal, uranium, and any other minerals used to generate energy, but does not include petroleum. It is a naturally occurring substance in the earth crust used as a source of energy. We also have another classification. In this case, we talk about precious metal. What are these precious metals, or what constitutes the class of precious metals? This class includes gold, platinum, palladium, indium, osmium, rhodium, iridium, ruthenium, selenium, and silver, or any other relatively scarce, highly corrosive resistant metal of high economic value. So these are what constitute the precious metal category for the purpose of calculating mineral royalty tax. The fifth class relates to gemstones. So when you hear of gemstones, what should be included in this class? This includes amethyst, aquamarine, beryl, corundum, diamond, emerald, garnet, ruby, sapphire, topaz, tourmaline, and any other non-metallic mineral substance used in the manufacture of jewelry. Mineral royalty rates are chargeable with reference to the type of mineral extracted or sold under a mining license as given. We have copper. Now for copper, prior to 2023, the mineral royalty was charged as follows. Under copper, the rate of mineral royalty chargeable on copper depended on the known price of copper as follows. That is prior to 2023. 5.5% of known value when the known price of copper is less than US dollar 4,500 per ton. Secondly, the rate used was 6.5% of known value when the known price of copper is $4,500 per ton or greater but less than $6,000 per ton. Also take note that we had 7.5% of known value as a rate applied when the known price of copper is $6,000 per ton or greater but less than $7,500 per ton. Later on, if the known value changes, the rate to be applied was 8.5% of known value when the known price of copper is $7,500 or higher per ton but less than $9,000 per ton. And finally, what was used on copper was 10% of known value when the known price of copper is or was $9,000 or higher per ton. Now for copper, this has changed. This has changed as now we use a new rate which is based on incremental rate. It is based on the incremental rate, and this incremental rate suggests the following: that as I've already said, that prior to 2023, the calculation of mineral royalty was based on the stepwise application of the rate to the aggregate value as opposed to the marginal value, and this increased payment distortions. How did this payment distortion come about? For instance, small differences in copper prices had significant threshold effect on revenue payment. For instance, a minor change in price of commodity, say by $1 change from $7,499 to $7,500 could lead to an increase in the effective tax rate from 7.5% to 8.5%. In order to minimize the distortion, the 2023 Zambia national budget restructured the mineral royalty regime with respect to copper, as the tax now apply on incremental value on each adjusted price band. That is a sliding scale, mineral royalty regime for copper. Mineral royalty regime for copper. So that's what you should also learn in this particular regard. However, for other minerals, under the base method, for instance, 8% of known value of cobalt produced or recoverable under license is what the mineral royalty calculation demands. Also, 5% of known value of base metals produced or recoverable under the license for base metals other than copper and cobalt. 5% of gross value of energy and industrial minerals produced or recoverable under the license. So mineral royalty tax also applies at the rate of 6% of gross value of gemstones produced or recoverable under the license. and 6% of known value of precious metals produced or recoverable under the license. Now, as I was explaining or looking at these particular mineral royalty taxes, a number of key terms were heard. I want to explain some of these key terms. For instance, the meaning of known value. When you hear of known value, you should take it that this is a monthly average London Metal Exchange cash price per metric ton, which is multiplied by quantity of the metal or recoverable metal sold. The monthly average fast markets cash price per metric ton multiplied by quantity of metal sold or recoverable metal sold, to the extent that the metal price is not quoted on the London Metal Exchange. Also, known value can mean that the monthly average cash price per metric ton of any other exchange market approved by the Commissioner General of ZAMBIA multiplied by the quantity of the metal or the recoverable metal sold, to the extent that the metal price is not quoted on the London Metal Exchange or fast market. So that's the meaning of known value. Can be looked at from those three angles. Let's look at also the meaning of gross value. So we find sometimes you base the calculation on gross value. So when we state gross value, what do we mean? For the calculation of mineral royalty, when you use gross value, this is to mean that value that is realized, or this is the realized price for a sale free on board at the point of export from Zambia or point of delivery within Zambia. In relation to these particular values, the due date can be said as follows. For mineral royalty is due and payable 14 days after the end of the month in which the sale of minerals takes place. You should also take note that a penalty of 5% per month or part thereof is charged on late payment of mineral royalties. Additionally, interest is charged on the overdue rate at the rate of 2% above the Bank of Zambia discount rate per annum. What is also important is to talk about the mineral royalty returns. With these mining activities, you should take note that monthly mineral royalty returns are due within 14 days after the end of the month to which the return relates. A penalty of 300 kwacha or 1,000 penalties for individuals, or 600 kwacha or 2,000 penalty units for companies is chargeable per month or part thereof for failure to submit a monthly mineral royalty return. So that's what we can talk about in terms of mineral royalties. For copper particularly, with the changeover, this is what the sliding scale method entails. When you look at the price range, where the price is less than $4,000 per ton, then the rate to apply the new system, that is since 2023, is 4%. In the next slice, where you have the layer of price range from 4,001 per ton or more, but less than $5,000 per ton, which implies that you are talking about the taxable amount, which is the next slice, which is $1,000. the rate of 6.5% applies. The next slice of taxable amount, the price range of $5,001 per ton or more but less than $7,000 per ton, which accounts for the next $2,000, the rate to be applied is 8.5%. Whereas for the price range of $7,001 per ton or more, whatever balance is remaining, that is subjected to 10%. So in part 2 of Zambian taxation, where I'm going to do the computation or give you some examples of how you calculate these royalties, I'll show you how to apply this particular sliding method of calculating mineral royalty, particularly for copper, and also I'll give you an example of how to calculate mineral royalty for other metals. Then we look at the other tax which a mining operation can be subjected to. This is in form of value added tax. This is in form of value added tax. So we should note that VAT is generally chargeable on goods and services supplied to mining companies. The rate that is generally applied for VAT is 16% in Zambia. You should note also that mining production is predominantly exported, and therefore, based on the destination principle of VAT, it is zero rated. Now, despite its intrinsic self-enforcement capacity, ZRI is faced with challenges to refund input tax, that is excess input credits, resulting in government to reintroduce the VAT Rule 18 in 2014. That requires the VAT taxpayer to submit documentation that a supply is an export of goods to claim this as a zero rate supply. We also look at another tax that can be affecting the mining operations, and in this regard we are talking about customs and excise duties. Import and export duties applied to materials, equipment and products. Okay, for import duty it is generally at 25%. Just productive productive machinery or agriculture sector or solar energy mining, we find that these attract import duty of 0%. For mining activity-related activities, you might find that there could be some duty exemptions. Okay, this is to encourage the growth of this particular very important economic activity in Zambia. We also have what we relate to as withholding tax. Now, withholding tax, as it affects the mining activities, plays a critical role in encouraging investments. For instance, 0% per annum is applied on any dividend paid by a company carrying out mining operations in Zambia. So this makes the investors get attracted to invest in mining activity, knowing that their dividends will not be subjected to withholding tax, or it is going to be subjected to a tax which is at 0%. Let's look at the other very critical aspect. This has to do with mining development agreements. Now, mining development agreements, these are contractual agreements between the government and mining companies. They actually define the fiscal terms, the incentives, and obligations. In this regard, they provide a framework of key terms to be included in the mining development contract and other related agreements with the state, including provision for stability to underpin the significant long-term investment required to develop and operate the mining project. Stability clauses are important. Okay. The provisions ensure tax stability over life of the project. When it comes to mining, it requires a huge chunk of investment, and the payback period might not be very short. So the investors will be more attracted to come and invest if at all they are rest assured that the tax regime won't keep on changing, because it will affect their planning and ultimately their profitability. So they need to be assured that what they are negotiating for might be sustained for a relatively long period of time for them to have a smooth mining operation which guarantees a sure return for their investment. The other important aspect that needs to be looked at is transfer pricing as it regards mining. What is the importance of this transfer pricing? So first of all, we need to understand what it means. Transfer pricing refers to the determination of the price and other conditions for the transfer of goods, services, and assets between affiliated companies situated in different jurisdictions. The importance of this transfer pricing cannot be overemphasized. It is needed for monitoring the pricing of transactions between mining companies and related entities. Where goods, intangibles, or services are transferred cross borders within a multinational enterprise, transfer prices become an important issue for taxpayers as well as national tax and customs authority that have the responsibility of overseeing these cross-border flows. So the other thing that can make us understand the importance of this is that it might affect both the payer, the taxpayer, and the government. For instance, if the transfer price is higher, okay, the exporter is going to actually end up having to pay more tax. The importer, on the other hand, might have the cost raised, therefore end up paying less tax. So that is a simple effect the transfer pricing has. To that regard, it's important to monitor these particular transfer prices of transaction between mining company and related parties, so that the price that is used is objectively determined. And when it is objectively determined, we say this price is determined at arm's length transaction. It's at arm's length principle. Transaction should be priced as if between unrelated parties. We cannot also overlook the aspects of environmental and social obligations put on the companies. Okay. The aspect of environmental and social obligations can have the following effect. One, it might require that the mining company incurs additional costs in order to comply with the environmental and social standards as spelled out by a sovereign state. So that should be looked at. Then also to encourage these companies to have this interest to still invest despite these additional costs, government has actually come up with a deliberate policy to make some of the environmental and social expenditure deductible for tax purposes. So that provides a relief to these mining companies. The other thing that needs to be looked at in relation to mining is what we call tax planning in mining. Okay. Tax planning in mining. So when you are talking about tax planning, you are looking at ways and means by which a taxpayer reduces the tax burden by legal means. So what are some of the strategies? Some of these strategies involve taking advantage of tax incentives and optimizing on capital allowances and managing royalties. Okay, so in doing that, there is need to be aware of a balance to be struck between tax efficiency and regulatory requirements. Now, tax efficiency is a means by which the enterprise or the entity minimizes the cost of complying with the tax code by reducing its administrative burden and minimizing any distortion in the economy caused by the tax. Now, in so doing, you might have to be affected by the tax regimes changes, for instance, okay, which can result in what we can call in economics deadweight loss. A deadweight loss consists of consumer surplus for buyers plus producer surplus for sellers who do not participate in the market for reasons other than the price of the product or service, resulting in less total surplus for the economy. Deadweight loss can also be created by artificial barriers to competition, such as occupational license requirements or artificial restrictions of supply by monopolies or oligopolies. So there is need to strike a balance between tax efficiency and regulatory requirements. In mining, all is not rosy. There could be challenges that can be faced by mining entities. These challenges are normally centered on the transfer pricing, disputes, and assessment of taxes and the audits. However, mechanisms have been put in place to ensure these particular challenges are resolved. So what type of resolution or what approach or what mechanism is going to be used in this regard? This is done by addressing disputes through negotiations or legal avenues. So that's what happens in this particular case. Now, when it comes to these particular challenges, a number of recommendations can be made. Okay, a number of recommendations can be made, especially where it affects the future of the mining in Zambia. Okay, so there are issues to do with the regulatory changes, and also the issues to look at in terms of sustainability of these particular operations. On the regulatory changes, okay, there are ongoing reforms and updates in mining tax laws. Okay, for instance, having noted that Zambia has a VAT refund problem, There's been a lot of effort that has been made by government in terms of review of legal framework, coming up with a strategy to combat VAT refund fraud, and also encouraging the Treasury to maintain a zero balance sub account within the Treasury single account, where amounts needed to pay the VAT refunds are transferred based on tax administration information. Secondly, there's need to harmonize corporate income tax rates. This can be done by raising rates on low tax sectors. This will reduce prospect of tax evasion and profit shifting. Furthermore, multiplicity of tax rates should be understood that it erodes the tax base, adds to the complexity of the administration of the taxes, and undermines the sense of fairness, as disproportionately heavier tax burden is placed on the non-priority sectors to collect the same revenue. Thirdly, government constantly should review the tax incentives. They should look at phasing out those tax incentives which are no longer serving their purpose, and maybe improve on those incentives which have outlived their usefulness also. Usually, we can also look at the aspect of the normal double taxation agreements that government has been subjected to or has entered into. There can be need to renegotiate these double taxation agreements, usually signed to give reciprocal treatment for business and transactions between countries, that has been crafted on the principle of residence or source of business. Where the double taxation agreement seem lopsided in favor of other countries, Zambia should move forward to carry out a renegotiation, or so should enter into renegotiation process. This is important because when you are looking at the future of mining, okay, as much as Zambia wants to generate as much revenue as possible, but it should also strike a balance between mechanisms that is going to be put in place to actually generate this revenue, and also look at what is it that they can give up to attract investment. So we need to have this mining activity sustainable. As you can see, Zambia largely depends on the activities of the mining, as it impacts it greatly in terms of economy. In conclusion, I can say that the mining sector is of great significance in Zambia's economy, and understanding its taxation framework is crucial for both investors and government officials. With this, I would like to end my presentation of part 1. We are going to look at part 2, which is going to be largely demonstrating how we calculate these taxes that affect the mining operations in Zambia. So please don't forget to subscribe to my channel and like my videos, and I look forward to meeting you next. Thanks for watching.